on the show. Rajat is now joining us. Rajat, thanks so much for taking out time for us. Could you just talk to us about what do you think is happening in the market? The correction was needed as there was absolutely no correction for the last few months or so, and markets went up one way.
Yeah, good afternoon. That is correct. I think a correction was needed, and it was always going to happen once the Fed started tightening liquidity. And they've been talking of late about increasing the pace at which they're going to slow down their bond purchases. So that is one thing. And on the other side, there is this whole Omicron virus scare, which nobody knows about how that plays out. There's been news about more supply chain disruptions if there is any lockdown in any countries around the world. But look, these things keep happening. The fundamental reality of the market is that they were very, very overvalued because of excessive printing of money. At some point, it had to be taken back. This led to a massive bubble in stock prices, and many started believing the earnings are improving, and earnings were not improving. Last year, we're coming from a really low base, which is why it's a scam. It looked very nice, but they've not been improving at the run rate at which they were improving in past. So once the Fed starts tapering down and withdrawing liquidity from the market will come back to where they should be. Everyone talks about everything going back to pre-COVID levels. Nobody talks about stock prices going back to pre-COVID levels. It couldn't be that simple that you have a pandemic and markets double up. So it's only natural that in course of time when money goes out, so will stock prices. They'll settle down.
The point that you're making that earnings are probably not comparable, and when you just compare it, you look you tend to see a very big delta change, but that may not be the case, which is absolutely correct. But what do you think about the balance sheet improvement? At least the larger ones, whether it's Tata Group all across, Birla Group all across, India Bulls Group, any big large corporate group that you would be talking about, Reliance Group itself, have done a lot of deleveraging during this entire COVID. It forced them, as sales was zero, and they had a lot of payments. So people stole stake, they got free cash flow, they got a lot of cost savings, and all of that led to debt improvement. Do you think those are some companies, some sectors, some group that you would look at?
No, that is a very, very good point. And I think the smarter companies, what they would do at times when interest rates are low, when there's so much liquidity, is they would do more issuances of paper and reduce the leverage on their books. And Reliance particularly has done that, and they've done that very well. In fact, last week I was reading about their treasury operations where, they've picked up money at very, very good rates in this time. Having said that, I'm not worried about what happens to balance sheets of some of these larger companies. If there is one sector where I'm really worried about, balance sheets of that sector, what happens going forward, that's financial services, particularly large banks. And I'll tell you why I say this. Why I say this is because over the last 2 years, since there's been a lockdown and everyone was working from home, nobody really has compiled, or at least I have not read anything about how much loan was restructured, how many people took advantage of the moratorium, did not pay interest. Everything keeps getting delayed. Auditors are being pushed to increase the time to 6 months, 8 months, and give us more time to make provisioning or declare NPAs. I believe that if interest rates were to go up, even by 25, 50 basis points, and cost of capital becomes expensive, you will see a lot of pain in financial services. It may not, it may be hard to believe right now because everything is hunky-dory, there's so much liquidity around, but something in me tells me this cannot go on forever. There must be some pain somewhere for people not working and not getting salaries and businesses being shut. How could that all just disappear? So I'm more worried about that sector. I think balance sheets there, it remains to be seen how they perform over the next 4-5 quarters.
So, two important questions regarding the banking space. One, you said that they have to go through a lot of pains. At least the larger ones have created a lot of provisioning, a lot of buffer has been created. So, comments on that. And secondly, I wanted to understand about this whole thing of NBFCs going on to buy now, pay later, consumer loans up to 2 lakhs. Do you think that's a big attractive market which actually goes? And then again, the deleveraging point that we were talking, if all big group deleverage, then how will loan growth happen?
Oh, exactly. It may be a very attractive thing for customers to, buy now, pay later, but it's a very dangerous thing for shareholders and businesses. This is a perfect case of, borrowing from Peter to pay Pan. There has been a moratorium in past. People have not paid up. banks have to, or these financial institutions have to manage their balance sheets well. Provisioning, I think, was increasing until last year, but this quarter we saw a lot of banks and NBFCs come out and decrease the provisions, which is why you saw, profits going higher. But I'm actually worried about a lot of these companies attracting customers to. The world is not been working as hard as it should have been. A year and a half back, there were NPA problems in March of 2020. There were problems with financial services. There were with financial services companies which were on the verge of bankruptcy all through the pandemic. We've not seen any of that happen. Everybody survived. It's just strange how that could be the reality.
Rajat, just request you to stay on with us. Our techies continue to be with us. We're taking a break. Coming back quickly as we speak. Nifty is down 200.
Okay, beginning to pretty much wind down for the day, and definitely we've been the global underperformers in that sense. Rajat, just wanted to understand whether you've been a buyer in the recent decline that we've seen from the October highs.
No, not at all, actually. The only thing I've done for a few of my client portfolios, and that's not for all of them, is that we've actually not sold off a lot of equity positions, but we've purchased put options for the month ending January. And that's to disclose about 1% of the total portfolio size. So, to give you an example, if somebody has a portfolio of 20 lakhs, then 1% would be something like 20,000 rupees and so on. So, 3 lots of Nifty for every 20 lakhs. So that's the only thing we've done for clients where portfolios are in equity and we've not sold off anything. But other than that, we've actually been sellers. So we've sold off stocks and holding cash.
Right, Rajat, that's an interesting strategy, the way you probably made those puts and then used it to hedge yourself.